Welcome to another episode of Delta Investments Deep Dive, where we go in depth and unpack our research on specific stocks and discuss the risks. We are recording this episode on Thursday, February 26, 2026. Major U.S. stock indexes closed higher on Wednesday, February 25, 2026, led by a strong rally in the technology sector. The S&P 500 rose 0.81% to 6,946.13, and the Nasdaq Composite gained 1.26% to finish at 23,152.08, while the Dow Jones increased by over 307 points. Investor optimism was fueled by NVIDIA, which reported record-breaking fourth-quarter revenue of $68.1 billion and provided a Q1 guidance that significantly exceeded Wall Street's expectations. Individual stock performance saw significant swings following earnings reports and industry developments. Netflix shares surged nearly 6% amid potential shifts in the streaming landscape involving Warner Bros. Discovery and Paramount Skydance, while Circle Internet Group skyrocketed 35% post-earnings. Conversely, First Solar shares plummeted 13%. In the software sector, companies like Salesforce and Oracle saw gains as the broader tech market recovered from a brief sell-off earlier in the week. The broader economic and geopolitical outlook remains a primary focus for investors as the IMF upgraded its 2026 U.S. growth projection to 2.4%, despite warnings about federal debt and trade tariffs. Global markets are also closely monitoring nuclear negotiations in Geneva ahead of a March deadline set by the Trump administration.
It really has been a massively busy week on the macro front.
Oh, completely. But I think we need to pivot today. While the broader market is sort of, popping champagne corks over NVIDIA and that huge tech rally we just talked about, there is a very specific corner of the market that feels a lot less like a celebration and a lot more like a gladiatorial arena.
Right.
I'm talking about HIMS and HERS Health Inc.
It is absolutely a battleground right now.
Yeah.
There's really no other way to describe it.
Yeah, and we have to do a deep dive on this today because looking at the stock, it's trading at $15.84 as of today, February 26th. And if you've been looking at the chart for the last 3 months, it basically looks like a heart monitor during a cardiac event. It has been wildly volatile.
Tumultuous is the word I would use. We are looking at a company that is posting incredible growth numbers on paper, right? But the stock price is telling a completely different story. It's a classic clash between really strong financial performance and just massive existential regulatory risk.
It feels like two different realities. On one hand, you have the financial statements, which we'll get into in a minute. And then on the other, you have this looming shadow of the federal government stepping in. But before we get into the weeds on the numbers, let's sort of set the stakes here for the listener. Why does this matter beyond just HIMS?
Because this is essentially a test case for the entire consumer health versus traditional pharma war.
Right.
HIMS is trying to do to healthcare what Uber did to the taxi industry.
Right, move fast and break things.
Exactly. They are aggressively pushing the boundaries of regulation to offer access, to offer cheaper, faster access to medications. And right now, the regulators and, frankly, the big incumbent pharma giants are pushing back extremely hard. If HIMS loses this fight, it changes the playbook for every single digital health company out there.
So it's not just about hair loss pills and weight loss shots anymore. It's about the entire direct-to-consumer healthcare business model itself.
Precisely. The stakes are huge.
All right, let's start with the hard numbers. They just dropped their Q4 2025 earnings a few days ago on February 23rd. And if you were just an algorithm reading the headline numbers, you'd probably think this was a total blowout quarter. Can you break the scorecard down for me?
Yeah, well, let's look at the bottom line first. They delivered a beat on earnings per share. They posted 8 cents against expectations of roughly 5 cents.
Wow.
Right? Which is a really solid beat. And then if you look at revenue, Q4 revenue was $617.8 million.
Which is huge.
It is. Yeah. Now, to be fair, that revenue number was slightly below the street's consensus for the quarter. But still, when you zoom out to the full fiscal year of 2025, revenue hit $2.35 billion.
$2.35 billion?
Yeah. That is a 59% year-over-year increase.
59% growth for a company doing over $2 billion a year. Usually the law of large numbers kicks in by now. You'd expect growth to taper off to, maybe 10 or 15%?
Exactly. That is hyper-growth territory for a business of this scale. And crucially, they aren't just lighting cash on fire to get those numbers.
Right, because that's always the big criticism of these direct-to-consumer brands, that they spend, $100 in Instagram marketing to acquire a customer who only spends $50.
Historically, yes, that was the model for a lot of these companies. But HIMS has really flipped that script. They aren't burning cash to survive.
So they're actually profitable.
Highly profitable. They posted net income of $128 million for the year, and their adjusted EBITDA came in at $318 million. And I know some investors roll their eyes when they hear adjusted EBITDA.
Oh, yeah. Earnings before bad stuff.
Right, exactly.
Yeah.
But in this case, the gap between their adjusted numbers and their real cash flow is actually very narrow. They generated $300 million in operating cash flow for the year. So this is a real business generating real cash.
Okay, so I'm going to play devil's advocate here for a second. You have a company growing revenue at nearly 60% for the year. They are highly profitable. They are cash flow positive. They beat on earnings per share by a wide margin. In a normal market, the stock opens up, 20% the next morning?
At least.
But instead, it tumbled. The stock price tanked. So what happened?
It's all about the guidance.
Yeah.
The market is a forward-looking machine, and right now the windshield has a giant crack in it.
Explain that.
Management projected first quarter 2026 revenue to be somewhere between $600 million and $625 million.
Okay. And what was the street looking for?
Analysts were anticipating $653 million.
Oh, wow.
Yeah. So at the midpoint of their guidance, they are guiding almost $40 million below expectations for a single quarter. That is a massive, massive deceleration. And when you are priced as a growth stock, deceleration is basically a death sentence.
Did management try to spin it? Did they give a reason, or did they just come out and say, hey, we have a huge problem?
They were actually surprisingly specific, which I think is what really spooked the market. They specifically cited a $65 million headwind due to changes in GLP-1 shipping schedules.
Changes in shipping schedules? I mean, that sounds like a logistics issue, like the warehouse manager called in sick or there was a snowstorm, but that's not what they mean, is it?
No, not at all. That is corporate speak for regulatory pressure. It means the FDA is breathing down their necks. It means they're either voluntarily throttling back shipments of their compounded weight loss drugs to fly under the regulatory radar, or they are facing actual supply chain constraints forced by compliance issues. Essentially, that $65 million is the actual tangible cost of their regulatory risk materializing right before our eyes.
So let's just rip the Band-Aid off and talk about that risk, because this is the elephant in the room for HIMS, the GLP-1 saga. For the last year or so, HIMS has been selling compounded semaglutide, which is basically generic Ozempic or Wegovy. And it's been a gold mine for them, right?
An absolute gold mine. I mean, drove a huge portion of that 59% growth we were just talking about. The demand from consumers for weight loss drugs is basically insatiable right now.
But then early February 2026 rolls around, and the vibe completely changes. Take us through that timeline, because it all happened incredibly fast.
It was a classic case of flying too close to the sun. So on February 5th, HIMS launched a compounded oral semaglutide pill.
This was the $49 pill, right?
Yes. And just to put this into context for the listener, the brand name version of oral semaglutide is Rybelsus, which is made by Novo Nordisk, and it is incredibly expensive.
Very expensive and hard to get.
Exactly. So HIMS comes out with a compounded version for a fraction of the price, $49 a month. This wasn't just some niche, quietly launched product. This was a mass market disruptor aimed directly at the general public.
And I imagine the FDA noticed immediately.
Oh, they noticed immediately. 2 days later, on February 7th, the FDA issued a statement, and they did not use soft language.
What did they say?
They labeled it an illegal copycat.
Oof. A legal copycat. I feel like once the FDA uses those specific words, your internal legal team just starts sweating bullets.
Yeah, it triggered an immediate crisis inside the company. The FDA signaled they would take decisive steps against compounded GLP-1 medications. And to HIMS' credit, they reacted instantly.
They pulled it.
They did. They agreed not to sell the oral pill following those safety warnings.
Yeah.
But the damage was already done. They had poked the bear.
And it wasn't just a sternly worded warning letter, right? This escalated to other government agencies.
Correct. The situation compounded, no pun intended. We saw a referral to the Department of Justice, the DOJ.
Which is terrifying for any corporate board.
Terrifying. And on top of that, there's now an ongoing SEC investigation into the company's business practices regarding these copycat drugs. So you really have this trifecta of government pressure. The regulator, which is the FDA, the enforcer, the DOJ, and the financial watchdog, the SEC, all looking at HIMS at the exact same time.
I want to make sure we understand the legal mechanism here, because I think a lot of people following this stock are a bit confused by it. How is HIMS legally allowed to sell this stuff in the first place? I mean, Novo Nordisk has a patent on semaglutide until 2031, right? So isn't this just blatant patent infringement?
That is a great question, and it hinges entirely on a very specific section of the Food, Drug, and Cosmetic Act involving drug shortages.
The shortage loophole.
Right, though I wouldn't call it a loophole initially. It was designed as a safety valve for public health. Under Section 503A and 503B of the Act, when a drug is on the FDA's official drug shortage list, which Ozempic and Wegovy were for a very long time due to that insane, unprecedented demand, compounding pharmacies are legally allowed to mix their own versions of the drug.
Right, to make sure patients who actually need the medication can still get treatment when the manufacturer can't keep up.
Exactly.
So effectively, as long as the shortage exists, the patent is suspended for compounders.
In a practical day-to-day sense, yes. The FDA allows it so that care isn't interrupted. But here is the trap. And it's the trap HIMS walked right into. Shortages do not last forever.
Right. Novo Nordisk isn't just sitting on their hands.
Exactly. Throughout late 2025 and into early 2026, Novo Nordisk poured billions into ramping up their manufacturing capacity. The shortage status has been steadily resolving.
Then once that shortage is officially over,
The compounding exemption vanishes overnight. If you are compounding a drug that is essentially a copy of a commercially available, FDA-approved drug that is not in shortage, you are breaking federal law. Full stop.
so what was HIMS betting on here? Were they just hoping the shortage would last forever? Or did they have some other legal argument lined up?
They were trying to pivot to the clinical necessity argument. They were arguing that their compounded versions aren't just exact copies. They were saying they are personalized. So, for example, maybe they add a B vitamin to the mix, or they adjust the dosage into a specific increment that the commercial Novo Nordisk pen doesn't offer.
I see. So they argue that makes it a different medically necessary product for that specific patient's needs.
That was the strategy. But the recent regulatory crackdown suggests the FDA simply isn't buying it. The FDA seems to view these mass-marketed, compounded weight loss drugs as copies, regardless of whether you add a little B12 to the vial. That's exactly why they use the term illegal copycat.
And then, as if the FDA, the DOJ, and the SEC weren't enough, in enters the 800-pound gorilla, Novo Nordisk.
Right, it's not just the government coming after them. On February 9th, Novo Nordisk officially filed a patent infringement lawsuit.
What specifically are they asking the court for? I mean, are they just looking for a slice of the pie, royalties?
No, they want an injunction.
That's the scariest word in corporate litigation.
It absolutely is.
Yeah.
They are asking a federal court to order HIMS to stop selling any product containing semaglutide immediately. They aren't looking for a fine or a licensing fee. They want to shut that entire business line down until their patent expires in 2031.
Wow. If that injunction is actually granted, what happens to HIMS revenue?
Well, we don't know the exact dollar breakout because HIMS strategically lumps that revenue into their broader subscriber numbers. They don't line item the GLP-1 sales perfectly.
Right.
But analysts estimate the GLP-1 business has been a massive chunk of their recent top-line growth. I mean, Wall Street hates binary risks, and this is a pure binary risk. Revenue goes to zero or revenue stays. If that weight loss revenue stream vanishes entirely, the stock price we see today, that $15.84, might actually still be too high. That is the fear that is driving this massive sell-off.
It sounds like they built this beautiful, fast-growing skyscraper on a foundation of sand.
Or, to put it another way, they built a skyscraper on a temporary building permit, hoping they could somehow permanently rezone the land before the permit expired.
That's a fantastic way to put it. Okay, so faced with this total existential threat in the U.S. market, HIMS didn't just curl up in a ball and wait to die. They went on the offensive. They went shopping. Let's talk about this strategic pivot. Project Eucalyptus.
Yes, this is honestly one of the most fascinating corporate pivots I've seen in a very long time. Just this week, right in the middle of all this domestic regulatory chaos, HIMS announces a $1.15 billion acquisition of a company called Eucalyptus.
First of all, $1 billion. $1.15 billion. That is a massive, massive deal for a company of HIMS size. I mean, their own market cap is under pressure. Who exactly is Eucalyptus?
Think of them as the HIMS of the Southern Hemisphere. They are a massive digital health leader based in Australia. They run several very successful brands over there. A brand called Pilot for Men's Health, Software for Skincare, Kin for Fertility.
So the branding, the direct-to-consumer model, the aesthetic, it's all identical to HIMS.
It's basically a carbon copy. They focus on that exact same millennial and Gen Z demographic. The sleek design, the seamless app interface, the easy telehealth access. But financially, they are an absolute beast. Eucalyptus has an annual revenue run rate an AR of over 450 million US dollars.
450 million. And what does their growth look like?
Unbelievable growth. They've posted triple-digit year-over-year growth in every single quarter of 2025. They are effectively doubling in size annually, and they're within line of sight of profitability, which is rare for an international asset growing that fast.
Okay, so they are buying a very high quality, high growth asset, but the timing is so wild. Why now?
Yeah.
Why spend over $1 billion when you are literally fighting for your life against the DOJ and the FDA in the United States?
Because it is a hedge. It is a billion-dollar insurance policy. By acquiring Eucalyptus, HIMS gets immediate, deep access to international markets where the U.S. FDA has absolutely zero jurisdiction. We're talking Australia, Japan, the U.K., Germany.
Oh, I see. Let's talk about that for a second. Jurisdiction arbitrage.
Yeah.
How is the regulatory environment in, say, Australia different from the U.S.?
Well, the TGA, which is Australia's equivalent of the FDA, has historically taken a somewhat different approach to compounding in telehealth. In some ways, their compounding regulations are a bit clearer, or at least they're different enough that the specific U.S. shortage list loophole issue doesn't apply in the exact same legal framework. Plus, Eucalyptus has already spent years successfully navigating those waters. They are the established market leader there.
So basically, if the U.S. doors slam shut on weight loss, they open a massive window in Sydney and Tokyo and London.
Exactly. Even if the U.S. weight loss revenue drops to zero tomorrow because of an injunction, HIMS suddenly has a $450 million and rapidly growing international engine that operates under completely different regulatory bodies. They are diversifying the regulatory risk. You aren't betting the entire company on one single agency's ruling in Washington anymore.
That makes total sense strategically. But talk to me about the price tag, $1.15 billion. Did they just write a check for that? I mean, do they have to dilute shareholders heavily to fund this? Because raising capital right now for them would be brutal.
The structure of the deal is actually incredibly clever, and I think it shows that HIMS management still holds a lot of cards. They aren't paying it all in cash today. The upfront cash portion is only about $240 million.
Oh, wow. Okay, that's totally manageable. They have that kind of cash on their balance sheet right now from the operating cash flow we discussed.
Easily. They are funding that upfront portion largely from their own balance sheet. The rest of the purchase price, the vast majority of that $1 billion, is structured as deferred payments and earnouts spread all the way through 2029.
Can you explain earnouts for the listener who might not be deep into M&A structures?
Sure. Basically, the founders and the current investors of Eucalyptus only get the full $1.15 billion if the company gets very specific financial and performance targets over the next 3 to 4 years.
I see. So if Eucalyptus's growth suddenly stalls out, HIMS ends up paying a lot less.
Exactly. And if Eucalyptus absolutely crushes it and keeps doubling revenue, HIMS pays more. But in that scenario, HIMS is essentially paying them out of the massive profits that Eucalyptus is generating for the combined company anyway.
It perfectly aligns the incentives. The Eucalyptus management team has to keep hustling to get their payout.
Precisely. And more importantly for HIMS, it protects their cash pile right now. They are not emptying their war chest right before they head into a massive, protracted legal battle with Novo Nordisk and the U.S. government.
Which is smart. Very smart. So this isn't their first international move either, right? I know they've been doing some other things globally.
Right. This Eucalyptus deal follows a string of recent integrations. They integrated Zava in Europe recently and Livewell in Canada. So you can see the broader strategy taking shape. They are aggressively building a global fortress.
So what are the analysts saying about this pivot? Did Wall Street applaud the move?
The reaction was pretty mixed. I thought Michael Cherney at Leerink, who's a very sharp analyst on the digital health space, had a really good take. He noted that strategically, the Eucalyptus deal fits perfectly. It matches the brand, it matches the emotional resonance strategy, it matches the target demographic. But he warned that it does not solve the immediate overhang in the U.S.
Right. Because buying a massive company in Australia doesn't stop the DOJ from filing charges against you in Washington, D.C.
Exactly. The market is so fixated on the short-term visceral pain of the GLP-1 issue and the DOJ and the SEC that they are simply not giving HIMS any credit for the long-term value of Eucalyptus yet. Wall Street is basically looking at HIMS and saying, hey, the Australia deal is nice, but are your executives going to jail?
That's nice, but are you going to jail? That really should be the title of this deep dive.
It really summarizes the sentiment perfectly.
Okay, so we've looked at the regulatory nightmare. We've looked at the international lifeboat they were trying to build. But I want to spend some time looking at the rest of the ship. Because before Ozempic mania completely took over the world, HIMS was a very successful company selling hair loss pills and erectile dysfunction meds. Is that original core business still alive and well?
This right here is the whole baby with the bathwater argument, and it is the foundational pillar of the bullish case for the stock. If you strip away every single dollar of weight loss revenue, just zero it out entirely, you are still left with a very healthy, rapidly growing, highly profitable core business.
Give us the stats on that core business. What does it look like today?
So they ended the 2025 period with 2.5 million total subscribers.
2.5 million. That's a lot of recurring revenue.
It's a massive. And what's really interesting is that the behavior of these subscribers is shifting in a way that creates a huge moat for the company. They are rapidly moving toward personalization.
Define personalization in the context of what HIMS does.
So historically, you would go to HIMS and just buy a generic finasteride pill for hair loss.
Yeah.
Right? The exact same pill you'd get at Walgreens. But now you go to HIMS and you buy a personalized HIMS chewable that mixes finasteride, minoxidil, and maybe biotin all in one custom dose. And it's flavored like a mint.
Okay, that sounds convenient, but why does that matter from an investor standpoint? Why is that a moat?
Because of switching costs and retention. If I'm just buying a generic finasteride pill, I have zero loyalty. I can switch to Amazon Pharmacy or Mark Cuban's Cost Plus Drugs tomorrow if they offer it for 5 cents less. It's a pure commodity.
Right.
But if I'm used to taking my very specific mint-flavored chewable that has my exact custom dosage of 3 different medications combined into one, I cannot get that at Amazon. I can't get that at my local pharmacy. I have to stay with HIMS.
It transforms a commodity medication into a sticky consumer product.
Exactly. And the financial data backs this up completely. In 2023, only about 30% of their subscribers opted for those personalized products.
Yeah.
By the first quarter of 2025, that number had surged. Over 1.4 million users were on personalized solutions. That's well over half their user base.
That is a massive shift in consumer behavior.
And HIMS reports that retention for these personalized users is structurally much higher. They were seeing over 85% long-term retention for that cohort.
85% retention in direct-to-consumer is almost unheard of. Usually churn is the silent killer for these subscription boxes.
Exactly. And these core segments, we're talking dermatology, mental health, sexual health, they are growing independently of all the GLP-1 drama.
And the margins on those core products are fantastic, right?
Oh, the gross margins on customized hair loss and ED meds are famous for a reason. They are incredibly high, which circles back to their financial discipline. We mentioned that $300 million in operating cash flow for fiscal 2025. Their adjusted EBITDA margins are actively expanding. They're targeting a 12 to 13% margin for the full year. So this core business is an absolute cash cow.
Okay, so management clearly sees this strength. Because alongside these earnings, they introduced some long-term targets for the year 2030 that seemed completely audacious given the current news cycle.
Audacious is putting it mildly. They came out and said they're targeting at least $6.5 billion in revenue and at least $1.3 billion in adjusted EBITDA by 2030.
Let me just pause on that. They are at $2.35 billion in revenue right now. They want to nearly triple the size of the business in the next 4 years. While the FDA, the DOJ, the SEC, and Novo Nordisk are all actively trying to dismantle their fastest growing product line.
I know.
Yeah.
It implies a staggering amount of confidence from the management team. It really suggests that they internally believe one of two scenarios is going to play out. Either one, they believe they will absolutely win this legal fight and find a way to keep the U.S. weight loss business alive, maybe by launching their own branded drug, or securing a massive partnership, or winning in court.
Okay, and what's the second scenario?
Scenario 2 is that they internally model the U.S. weight loss revenue going to zero, but they believe the international expansion with Eucalyptus, Zava, and Livewell, combined with the hyper-growth of their personalized core business, will be so explosive that it simply dwarfs the loss of the GLP-1 revenue over the next 4 years.
That is a wildly bold bet. But, Andrew Dudum, the CEO, has never really been shy about his ambitions.
No, he hasn't. He fundamentally views HIMS and hers as a tech company. And in Silicon Valley, you set impossible moonshot goals, and then you force your team to figure out how to hit them. The friction here, though, is that healthcare is not software. You cannot just push an over-the-air update to patch a federal drug violation. The real world has real regulators.
Right. The code doesn't matter if the DOJ unplugs your servers.
Exactly.
So that brings us to the final section of our deep dive today, valuation and investor sentiment. The verdict. The stock is sitting at $15.84. We have laid out a terrifying multi-agency regulatory landscape on one side and a booming, highly profitable underlying core business on the other. How on earth do investors value this thing right now?
It's essentially a tale of two spreadsheets at this point. Wall Street sentiment is incredibly cautious. You've had major firms aggressively slashing their price targets after this recent earnings report. Barclays, Truist, Morgan Stanley, they all slashed their targets down to the $17 to $18 range.
Let's walk through the bear case first. Why should an investor stay far, far away from this stock at 16 bucks?
The bear case is basically a story of multiple compression. Look at Bank of America. They put an underperform rating on the stock. Their primary argument is that HIMS is going to lose its growth premium.
Yeah.
If that GLP-1 revenue is forced to vanish by an injunction, HIMS goes from being a company growing at 60% a year to a company growing at maybe 20% a year.
And the market simply does not pay a premium tech multiple for a 20% grower in the healthcare space.
Exactly. The valuation resets completely. Plus, you have the legal hair on the stock. Institutional investors hate legal uncertainty. A lot of major funds literally have compliance departments that tell their portfolio managers you cannot initiate a position in a company that is under active DOJ or SEC investigation.
Oh, so you have forced institutional selling just based on internal compliance mandates.
Yes. The bears think this forced selling and multiple compression drifts the stock down to $10 or even $8, essentially valuing it as a slow-growth utility that happens to have massive legal bills.
That is grim. Okay, now give me the bull case. Convince me to buy HIMS at $15.84.
The bull case is entirely based on a discounted cash flow, or DCF, analysis of the core business. If you assume the absolute worst-case scenario, you assume the GLP-1 revenue goes to absolute zero tomorrow, you wipe it completely off the income statement. But you keep the core hair, skin, and ED business growing at its historical 20 to 30%, and you add in the $450 million in revenue from Eucalyptus.
What does the math look like?
The math suggests a fair value somewhere around $30 a share, which implies almost 100% upside from where we are today.
So you're saying the core business alone, excluding weight loss completely, is worth double the current stock price?
That is exactly what the bulls are arguing. They are saying the market is completely overcorrected. Investors have panicked. You are getting a highly profitable cash-generating business with a massive, rapidly expanding international footprint for rock-bottom price. And it's a massive but if they actually survive the GLP-1 legal fight, that revenue is just free upside. It's a lottery ticket attached to a value stock.
I see the logic, but catching a falling knife is notoriously dangerous in this market.
It is. And technically speaking, the stock chart is broken right now. It's trading below every major moving average, the 20-day, the 50-day, the 200-day. Momentum is strictly downward. We have to remember, this stock was trading well into the high 20s, and some analysts had targets in the 30s not that long ago. It is retraced significantly.
So the smart money is just waiting on the sidelines.
For the most part, yes. Most institutional investors are sitting on their hands. They're waiting for some modicum of clarity. They want to see the result of the Novo Nordisk injunction hearing. They want to see if the DOJ actually files formal charges or if it just results in a fine. Until those specific binary events are resolved, the underlying fundamentals of the core business just don't matter as much to the algorithms as the daily news headlines do.
It's a high-stakes waiting game.
It truly is.
Well, we have covered a massive amount of ground today.
We really have.
So to recap everything we've unpacked for the listener, HIMS and HERS just delivered a monster 2025 financially. Over $2.3 billion in sales, wildly profitable, huge cash flow, but they are walking straight into a regulatory hurricane in the U.S. The FDA is labeling their weight loss products illegal copycats, and Novo Nordisk is trying to sue them into oblivion.
Correct. And their primary counterpunch is this massive billion-dollar international expansion through Eucalyptus to diversify that risk away from the U.S. regulators. But right now, the stock is being severely punished for the uncertainty, trading at nearly half of what it was recently worth.
It is incredible corporate drama, and I want to leave everyone listening with this final provocative thought to chew on. We often talk about disruption in Silicon Valley like it's just a fun buzzword, but this right here is what real messy disruption actually looks like. It's brutal legal battles. It's the government versus the innovators. So the big question for you to consider is this: is HIMS and HERS just a healthcare company that got caught breaking the rules and is now about to pay a massive price? Or is it a genuine tech disruptor that is simply moving way faster than our archaic regulatory laws can keep up with? And crucially, if that U.S. door closes permanently, will the international window they just bought be big enough to justify their valuation?
That is the multi-billion-dollar question. We will definitely be watching the docket for that Novo Nordisk hearing very, very closely.
We hope you enjoyed this deep dive, and thanks for listening. Please follow us and subscribe on your favorite platforms. Until next time.
Thanks for listening, everyone.
This analysis is based on publicly available information and does not constitute financial advice. Always conduct your own research before making investment decisions. By listening to this podcast, you agree that you are in charge of your own decisions and risks and that you are solely responsible for any investment decisions you make.